Swayam Prabha. Digital India. Educated India.
Hello everyone, welcome to this session on the bond market and interest rate determination. In this lecture, we will explore how interest rates are determined by the interaction of demand and supply forces. And bonds are, we have already defined, are the debt instruments issued by governments and corporations with or without periodic payment, that's the coupon payment. A central idea in the bond market is the inverse relationship between bond price and the rate of interest. So in the previous session, we have seen that when the rate of interest rise, the bond prices fall. And when the rates fall, the bond price rise. So these relationships play a key role in monetary policy and financial decision making. So in this session, we will look at what drives the supply of and demand for bonds and how factors like government borrowing, inflation expectations, and investors' behavior shift these curves. So we'll also examine how these shifts affect market equilibrium, bond prices, and interest rates. So let's begin by identifying the key participants in the bond market and the basic supply and demand framework. And here I also want to recollect that in one of the previous sessions, we have discussed the supply and demand framework, and we are going to use that framework here. I hope that it will be much easier for you now to use that framework here to understand how rate of interest are determined or how bond prices are determined. So let's move to the bond market. Who are the participants here? So here we will be describing the factors that affect equilibrium interest rate in the bond market. So here the supplier of bond, they are the borrowers. They are the borrower or who issue the bond. So mainly governments, sovereign governments, and firms are the main supplier of bond. They are the main borrower of funds from those who lend them. So the demand for bond comes mainly by lenders. Lenders are the main demanders of bond. They consist of mainly households, financial intermediaries including banks, pension funds, mutual funds, etc. So they are the demanders of bond. Here I need to highlight banks. In India, for example, most of their investment in banks are mainly in government bonds. In other words, they are the demanders of bond. So actually, you know that the money that is with the banking system is by the general public. So in that way, our money is already invested in the bonds by the banks. Though we are not directly investing, we can do, many people do, but most people, they don't directly invest. The banks will be investing because we are investing our money in the bank as a deposit, and banks will be using this money to invest in the bond market. So let us see how market equilibrium is determined using the supply and demand in the bond market. So what you can see here is that at lower prices, that means since we already seen the inverse relationship, the lower bond price means higher interest rates. Keeping other things remaining constant, that is a ceteris paribus assumption, the quantity demanded of bonds is higher, an inverse relationship. So that means at a lower price, you will be buying more. The quantity demanded of bonds is higher, an inverse relationship is, you can see there. A lower prices, the quantity supplied of bonds is lower, a positive relationship. So let's look at here. You can see that an inverse relationship, a downward sloping demand curve. This is the bond demand curve, and this is the bond supply curve. So in this here, what you can see that when the price is low, households are going to demand more, or the lender, I mean banks, households, and other financial institution, they are going to, when the price is low, they are going to demand large quantity of bonds. Why? When the price is low, you know that the rate of interest is high. So that means when the price of a bond declines, they will be demanding more and more because they are going to get a high rate of interest. In contrast to this, the supplier of the bond, when the price is high, they are going to supply more bonds, they are going to issue more bonds in the market. That means higher the price, lower the rate of interest. That means when the bond prices are increasing in the market, the supplier of the bond, they are willing to borrow more because they need to pay low rate of interest, because we already seen the inverse relationship between bond price and rate of interest. So the equilibrium position here is this is the equilibrium position where the demand for bonds intersect with the supply of bonds. So at this point, you can see that it occurs when the amount that people are willing to buy, the demand, equals the amount that people are willing to sell at a given price. So at this point, you can see that the bond demand is equal to bond supply, that is the market equilibrium. So you can see at the given bond price 850, the quantity demanded and supplied in this market is 300. 300 is the quantity demanded and supplied, $300 billion when the price is 850. So from this, you can also see the corresponding rate of interest. From this, you can see the corresponding rate of interest is 17.6%. So what if the bond demand is greater than bond supply? Suppose, let us look at this point A or point B. So point A or point B is not going to be the equilibrium position. Equilibrium position is going to be C, right? So at this price, what is going to happen? Suppose the bond demand is greater than bond supply. So that means there will be excess demand here. So mainly bond demand is greater than bond supply here. For here you can see this is the position where you can see BD. At this range, you can see BD is greater than BS. So there is excess demand. Then you can see that there will be a rise in price because the quantity supplied by the firms and government, bonds issued by them, is only this much. But households and banks, they are willing to lend. They want to lend in the finance market, debt market. So they want at this rate of interest, the rate of interest is 33%. When the bond price is 750, they want to lend $500 billion. But at this low price or high rate of interest, the bond supply is going to be only $100 billion. That means the government or firms, they want to borrow only 100 billion, but the households and banks and other financial institutions, they want to demand bonds worth 500. Then obviously you know that when there is excess demand, the price will rise and interest rate will fall. So this is the pressure. There will be an upward pressure the bond price. In other words, there will be a downward pressure on the rate of interest. So similarly, in contrast, when the bond demand is less than bond supply, so that is at this position, the point A. So you can see that this much is the excess supply of bonds in this market. So bond demand is only 100. Now bonds supply is 500. So you know that at this the bond price is very high, 950. 950 is the bond price, but the rate of interest is 5.3. So there will be, because of that, there will be a downward pressure, because they want to, the suppliers of bond, they want to borrow 500 billion from the market, but the lenders, they want to lend only 100 billion. So in order to incentivize, the market will be mainly the suppliers, they are willing to reduce the price. That means they are willing to pay more rate of interest. There is a downward pressure on price. In other words, there will be an upward pressure on rate of interest. So the changes in equilibrium here, then it happens when if there is a shift in supply curve or the demand curve, we can also see that the market equilibrium price will change. But For the moment, you have just recalled that the supply curve or the demand curve is shift when the price remain constant, right? So here, when the price is, for example, at a given price, just take this is the price, for example, 100 is the price of this bond. Then given the price is constant, if there is same price, if the firms or government want to borrow more, then there will be an increase in the supply of bonds that will shift the bond supply curve to the rightward. So here you can see this is how the shift happen, and what are the factors that drive a shifts in the supply of bonds at the given price or the given market rate of interest. One is government budget. So that is the changes in government borrowing. For example, if there is an increased budget deficit, that is going to shift the supply curve to the right. So what is meant by increased budget deficit? Budget deficit means the borrowing requirement of the government. When the government expenditure is greater than the government revenue, so the remaining amount they need to fill it up by borrowing from the market. That actually often approximately around 30% of the government of India budget is equal to the budget deficit that they normally finance that much amount of money mainly from the debt market, that is by issuing or supplying bonds. So if the budget deficit increases, then obviously you know that when the government is spending more but the corresponding revenue is there is no raise, then that means the budget deficit is keep on increasing year after year. Then what you can see that the government has to finance this budget deficit by borrowing from the market. So as a result, at the given, whatever the given market rate of interest or given price, they still borrow, they issue more and more bonds. So as a result, the curve will be shifting to the right. The second one is changes in general business expectation. Suppose overall economic and political environment in the country and globally is going to be very optimistic. So that means the expected profitability of investment opportunities increases for firm. So in that time, firms want to expand their production capacity. They want to produce more goods and services. So in this expansion, they need fund. They need capital. So at the given market rate of interest, they are willing to supply more. As a result, the supply curve will be shifting right. So similarly, if there is an expected inflation, an increase in expected inflation shift the supply of bonds to the right, because higher expected inflation means lower real rate of interest. So that means the lower real cost of borrowing. As a result, if the firms anticipate that in the future the rate of inflation is going to increase, that means the future value of money is going to decline. So they will borrow more, because in the future they need to pay the amount agreed, but the value of the repayment amount will be low because of the expected inflation. So I am providing you a summary of the shifts in the supply of bonds, what is going to happen. So just I am showing when there is an increase in budget deficit, profitability of investment and expected inflation, then what are the given market rate of interest, still instead of borrowing this much, they are going to borrow more. They are going to supply more bonds in the market. Similarly here as well. So here, what would happen to bond price when supply curve shifts? That means other things remaining constant. So here, suppose they issue more bonds. Suppose the given price is, for example, P naught. Obviously, you know that there is a corresponding rate of interest as well. So the market demanded and supplied quantity of bond is Q star at the price P star. So due to the factors which we mentioned just a few seconds before, the supply curve shift to the rightwards. So let us see what is going to happen. So the supply curve shift right. So you can see that bond price declines. So bond price decline means the rate of interest is going to increase. So when the rate of interest is going to increase, the demanders of bond, that the lenders, they are going to lend more. They are going to lend here this much. So further, if there is a leftward shift, that means they are issuing less bond, the quantity of bond issued is less, then in this case what you can see that the price increases. In other words, the rate of interest decline. When the rate of interest decline, the demand for bonds decline. So here, when in the first case, we can see the bond price would decrease. That means the rate of interest would increase in this scenario, and vice versa in this case. So let's now move to the shift in the demand curve for bonds. Why the lenders, they want to lend more at the given market price or at the given rate of interest, that one remaining constant. So an increase in the demand for bonds shift the bond demand curve rightwards. So just like that we studied in the simple demand framework, here also when there is an increase in demand for bonds at the given market price of bonds or at the given rate of interest, then suppose the price is this one and maybe the households are having more money, they want to lend, then they at the same rate of interest, they are now willing to demand more, they are willing to lend more. So there are a couple of factors that drive the shift in the demand for bonds. One is increase in wealth. Suppose you are a regular lender and your wealth has increased now. So in an expansion with the growing wealth, or the GDP has been growing exponentially and everyone's standard of living has increased, everyone's saving has increased, the wealth has increased. So in an expansionary economy with a growing wealth, the demand curve for bonds shift to the right. So similarly, if there is a decrease in expected rate of inflation rises, expected returns for bonds and causing the demand curve to shift to the right. And similarly, a decrease in expected future interest rate, that will also lead to, that makes bonds more attractive, shifting the demand curve to the right. What does it mean when I say there is a decrease in expected future interest rate? So that means when the expected future interest rate decline means the expected future price of bond is going to increase. That means in the future, after 5 years, you think that the bond that you are going to buy today, the rate of interest is going to decline considerably after 5 years. Then that means your price of your bond is going to increase because of the inverse relationship between rate of interest and bond price. So because of that, you are going to invest more in the bond market because the price of the bond, when you are selling this bond in the market, you are going to get more high price, and because of that you will be making a more capital gain. So similarly, some more factors: increase in expected returns as compared to alternative investment opportunities like equities, then you are going to invest more. Decrease in risk. So when the bonds going to be, the riskiness of bonds declines, then the demand curve going to shift to the rise. Similarly, increase in liquidity. Increased liquidity of bonds means you can transact, you can sell your bond at any time with much ease. That means the secondary market, the bond market is well developed and you can sell your bond at any time. So that means there is increase in liquidity. So that makes bonds very attractive, and then as a result, even the rate of interest is maybe at the given rate of interest itself, you are willing to demand more bonds. So here again, let's see what would happen to bond price when demand curve shifts, other thing remaining constant. So the example, the case here, the bond price is P star, the quantity demanded and supplied is Q star here. Suppose there is there is increase in demand, that the demand curve shift to the rightwards. Then you can see that the new equilibrium position is going to be this. So what you can see here is that the price has increased. So price has increased means nothing but rate of interest has declined. Rate of interest has declined. That means when household is demanding more bonds, or the lenders, the banks and households are demanding more bonds, the demand curve shift rightwards, obviously here. But since they are demanding more, there will be a upward pressure on price because they are demanding more. Then that means the lenders are willing to accept low rate of interest. So actually the firms, they don't want to borrow. There is nothing, no changes happen. Assume that there is no changes on the supply side. So this is the ongoing price P star, and that is the corresponding rate of interest. But now the lenders, the households and banks, they have more funds, they are demanding more bonds. Then as a result, they are pumping more money into the bond market. As a result, the rate of interest will decline and the bond price will increase. So you can see the price has increased, that means the rate of interest has declined. So similarly, some more factors, for example, response to a change in expected inflation, how is going to affect the market rate of interest. So this is the initial equilibrium position at this point. Assume that there is a rise in expected inflation. Then step 1 here is that shift the bond demand curve, shift leftward, that is here. And the bond supply curve, it is shifting rightwards, the reason that we discussed a couple of minutes before, causing the price of bonds to fall and the equilibrium rate interest rates to rise. You can see that the new price is going to be P2. This is the new price. That means the price declines. When price decline means the rate of interest has increased. So this is the new quantity, because now we made equivalent changes in both demand and supply. But as a result, what happened here is that the change, what we can see that it's not very equivalent change. Because of this change, what we can see that the price has declined, the rate of interest has increased. So similarly, response to business cycle expansion. Step 1 here, a business cycle expansion shifts the bond supply curve rightward because firms are now willing to invest more in the production of goods and services. That means they are going to make more investment in the resetting of factories and expanding factory and buying more capital equipments. And step 2 here is that shift the bond demand curve rightwards, but by a lesser amount. So because their income also increases by when expansionary business cycle happen, but it will take some time. So the price of bond falls and the equilibrium rate of interest rises here. So what we have seen here is that in this discussion and just few minutes in the previous session as well, we highlighted the inverse relationship between interest rate and bond price. So let me now make it using some illustrative example. Let me make this idea very clear to you using some illustrative example. Suppose a coupon bond. Coupon bond means you can just take a 5-year bond or 10-year bond issued by Government of India. Government of India bond for example 10 years, that is a coupon bond. So any bond issued by Government of India above 1 year is normally coupon bond. So when a coupon bond is priced at its face value, the yield to maturity equals the coupon rate. Suppose the coupon bond is today sold at exactly at its face value, then what we are going to see that is going to be the yield to maturity, the rate of interest is going to be the coupon rate. The price of a coupon bond and the yield to maturity are negatively related, that we already seen. So let's take this example. What if the current market interest rate changes? Mean I is not equal to the coupon rate, which is an actual reality. So in this case, the illustrative example using this table, yield to maturity. So you just go through this line, that the yield to maturity, that is the market interest rate on a 10-year coupon rate bond maturing in 10 years. That is with a face value of 1000. So what I have seen here is that what we are doing, that we are changing the yield to maturity here. We are changing the yield to maturity. So in the yield to maturity, we are changing. So suppose the yield to maturity, that the current market rate of interest is 10%, that the coupon rate is also 10%. That we keep constant coupon rate, because it's already agreed in the bond, it already comes with that the coupon rate is 10%. The face value is also well predefined in the bond, that is 1000. Then what happened that when the market rate of interest declines, then you can, it declines here like this, then what you can see that the bond price is going to increase. So read here the first row you can see that though the face value is 1000 and coupon rate is 10%, but the market rate of interest has now become 7.13. Right, whoever is holding this bond, they are going to get that the 5% 6 months. but 10% annually. They are going to get 10% annually they are going to get. But the market rate of interest is only 7.13. That means whoever is holding this bond, they are going to get 10%, but market is providing you only 7.13. So in that case, this bond, when government is selling this bond, they won't be selling this at 1,000. They will be selling it at 1,200. But in contrast, what the ongoing market rate of interest is greater than the coupon rate, then that means the bond is paying you only 10%, but the ongoing market rate of interest is 11.75 or 13.81. So in that is the case, the issuer will be getting less than 1,000. The buyer will be willing to pay 900 or 800 correspondingly. So simply what we have seen that when the yield to maturity, the ongoing market rate of interest is less than the coupon payment, then the bond price is going to increase. In contrast, when the ongoing market rate of interest is greater than the coupon rate, then the bond price is going to decline. And when both are same, when yield to maturity and coupon rates are one and same, then the bond will be priced at its face value. So a 1,000 face value having a bond will be sold at 1,000. So it's all because of the inverse relationship between bond price and interest rate. So in this case, the inverse relationship, we can also elaborate this point using a perpetuity bond. That means that the lifetime is forever. So suppose a government bond with a market price is 1,000, annual coupon payment is 50, because the rate is not mentioned any rate, is clearly say that 50, that means 5%. So this is a perpetuity bond with no principal payments, so return only via resale. So the key motivating question here is that what happens to capital gains or losses when the market interest rate changes. So what I see that at purchase, assume that you bought this perpetual bond 2 months ago. At that time, market interest rate is 5%, and the perpetual, this one, for example, for instance, the annual coupon payment is also 5%. So that means the bond price, the resale value is going to be same. So the capital gain or loss is same, because the 5% is the market interest rate, the coupon payment also same. So somebody buying this fund will be buying at the same price, that the face value is going to be the bond is going to be the bond price itself. But what if after 1 month of buying, the market rate of interest become 10%? So that means anyone investing this amount 1,000 in the market are going to get $100, right? But this bond, if someone is buying, going to get only 50, right? So idea here is that when the ongoing market rate of interest is 10%, so when you invest 1,000, you are going to get 100 as the return. But this particular bond, they are paying only 50. That means in principle they are paying only 5%. So that means in order to get this 5%, this 50, you need to invest only 500 instead of 1,000. To get 10% rate, you need to invest only 500. That means whoever is willing to buy this 1,000 bond are willing to pay only 500 here. So that means if you have invested in this bond purchased 2 months ago at a ongoing market rate of 5%, but today after 1 month the market rate of interest became 10%, then you incurred a capital loss of 500. So that means you made a loss. So today, for example, the rate of interest is 2%. That means this bond, when you are, because the condition remaining same, 1,000 bond, this perpetual bond will be providing you $50. But when the market rate of interest is 2, in order to get $50 as the return, you need to invest 2,500. That means the bond that you bought 2 months ago, now you can sell at 1,500. So this is the key insights here. When interest rate rise, bond price decline, then you make capital loss, and when interest rate decline, bond price increase, then you make a capital gain. So I'm showing you some screenshot, some text from which I collected from the newspaper. So simply you can look at here, which I was referring. Just read it. For example, 7.7% 10-year benchmark bond. So what does it mean? That 7.17, that is the coupon rate. At 10-year is the period of maturity. Slip to this amount. So these changes happen because of changes in the market rate of interest. So you can accordingly, keeping this idea, you can read Financial Daily, keeping this principle in mind. I'm also referring you some more screenshots from RBI website. They have defined what is meant by different government security, and related informations are given here. So I am also giving a little bit more information about the Fisher effect, which we already discussed in one of the previous session. Just to calculate this one, that the Fisher equation is the nominal interest rate is equal to real interest rate plus expected inflation rate. So what we have done here is that in this session, we discuss demand and supply framework, and using that, we see how market rate of interest is determined, or in other words, how bond prices are determined. And subsequently, using some illustrative example, we discuss the idea of inverse relationship between bond price and rate of interest. Thank you for watching this session. See you in the next session. Thank you.